Hi guys, welcome to this new session of CFA Level 2 Corporate Finance. Today we'll be covering the entire remaining portion of mergers and acquisitions. So today would be the last class of corporate finance as such. We'll be finishing the entire corporate finance curriculum today. So without wasting too much time, let's get into the first major topic we have. So we have two major topics to discuss today. One is the valuation of target firm. So if I am an acquiring firm and I want to acquire certain company, what might be the way in which I could value that target company? That is one of the major topics we have for today. And another major topic is simply talking about synergies and how the takeover synergy is distributed between the target and the acquiring firm. So the first concept, so the first heading that we have is valuation of target company. Now I should make it very clear right now that your entire syllabus of CFA Level 2 equity is also focused on valuation of shares by various approaches, and everything that we'll cover in this topic is covered in much more detail. Like the two headings that we are going to cover in this particular chapter, in this particular section of this reading, they are their own separate chapters, their own separate readings when you get to equity. So keep in mind, for corporate finance, only the basic level calculations are necessary. The complicated detailed portion, we'll be covering that as we go along to equity parts. So there are two valuation techniques that are highlighted in your syllabus for this chapter. One is the discounted cash flows, and the other is a multiples based approach. Now, let's first discuss discounted cash flows. So far, we have done at level 1 also various techniques of valuation of equity shares where we have continuously used cash flows. If you remember from level 1, dividends based valuation, we used to have an equation something like this: D1 upon 1 plus R. R would be cost of equity plus D2 1 plus R square. So on Dn plus Pn 1 plus Rn. Mostly this was covered in case of a two-stage model where you had dividend initially growing at a higher growth rate and then eventually it would grow at a stable growth rate. So your price used to be terminal value. We are going to use the exact same logic here. The only difference is instead of dividends, because I'm not valuing the equity shares of the target company, I am valuing the entire company. This is valuation of target company, not valuation of equity shares of target company. So for the entire company, I should be focusing on free cash flows. Free cash flow to firm if you want. 1 plus R. Now because I'm taking entire firm, this R would become weighted average cost of capital. So first year's free cash flow, second year, and so on till the end where I have free cash flow to firm year end discounted for n number of years. But aside from this, just like we had with dividends, we had a terminal value. Here also we'll have a terminal value. This terminal value is calculated by using the same logic of a Gordon growth model. Free cash flow to firm for year n 1 plus G R minus G. Now, if you remember at level 1, this used to be Dn 1 plus G or Dn plus 1, whatever you feel comfortable with, upon Ke minus G. This is basically the Gordon growth model. We are using the exact same logic here. The only difference between the first and second equation is instead of taking dividends, we have shifted our focus to free cash flow. That's it. That's the only change you have for this entire concept. Not quite the only change. There is one more small change. If you remember from level 1, we had a proper equation for calculating free cash flow to firm. It was part of your FRA curriculum. Now at level 2, The same concept, the same valuation technique is used in corporate finance and it's used in equity. The equation that you remember from level 1, that is going to be used when you cover equity. The equation that you have to use, or the formula or the method that you have to use to calculate the free cash flow for each of these years for CFA level 2 corporate finance is slightly different. Let's have a look at that. So this is the equation that you are going to use for corporate finance. Now, the very important thing that you should know is that the equation that we're using in corporate finance and equity, mathematically they would give you the exact same result. So don't all of a sudden be afraid that now you have two equations for a small concept. You have two equations, but they are mathematically the same. So in exam, if you get the option, you can solve it using either first one or the one we cover in the equity portion. So that's the good thing. But the important reason why we have two different equations, I want to cover that first before we look at this. If you remember from level 1, in FRA we used to have a format of income statement. It used to have revenue, then it used to have all expenses where we had administration, selling expenses, distribution expenses, production expenses, overheads, depreciation, everything. Whereas when we covered the chapter of leverages from CFA level 1 in corporate finance, the statement of income that we used to prepare, it's not going to be given by the company, but what we used to make had sales, contribution, EBIT, EBT, all of these elements. There is a key difference between how FRA or accountancy handles a financial statement, an income statement, and how we as analysts use it specifically for the analytical purposes. Due to that difference in formats, this is the change in equation you have. So it's only because we use two different formats for corporate finance and for equity and financials. That's the only reason why the equation has slightly different terms. Otherwise, mathematically, logically, exactly the same thing. The idea for free cash flow was I look at net income, I adjust for non-cash charges and non-operating charges, and then I finally get to my working capital adjustment and capex adjustments. So it's the same thing happening here. Let's look at the equation. The starting point is net income. I am first adding back the interest. Now, if you look carefully, net income is already after the adjustment of tax. So tax has already been paid. I am adding back the interest, only the interest portion net of tax, because at the end of the day, interest by itself is non-operating in nature, but the tax it saves me is my income tax, my operational tax. So I'm only reversing the effect of interest net of tax because this is a financial cost for me. Then we move on to change in deferred tax. The reason why we have change in deferred tax is fairly basic. Deferred tax as a nature of the item of accountancy goes, it's a non-cash item. Deferred tax simply means it's a tax you were supposed to pay this year, but you might end up paying in the future years. So effectively, you haven't paid it in cash. You might have to pay it in future. So it's just an accounting adjustment due to accrual concept. This is a non-cash item. That's why it is adjusted here. And you can have other non-cash expenses also like depreciation. The primary reason for adjusting the interest is fairly basic. If I'm taking free cash flow for the firm, I should not be making payment to the equity nor to the debt holders. So I am reversing the effect of interest so that I have a situation where I have not paid any sort of amount to my bondholders or any providers of debt. Then you have your basic adjustment for working capital, and lastly you have capex. Now, one other term that is often repeated is this, the combination of just first three elements. So the equation is going to be whole, but the combination of first three elements is known as net operating profit less adjusted taxes. This is a term that you should know for one very simple reason. Often in exams or in questions, for corporate finance specifically, the institute could directly give you the value of this. So you should know what elements in this equation together combine to form net operating profit less adjusted taxes. If you think logically, The first three elements, net income, I have reversed the interest, I have reversed the deferred tax. If I reverse the interest from net income, it creates a situation where I have EBIT. So if you think logically, you have EBIT minus interest minus tax, and you have net income. If I am going in reverse order, I have taken net income, I have reversed for interest. Keep in mind taxes. I am only reversing the non-cash portion of taxes because at the end of the day, I do need the cash portion of taxes for my free cash flows. So taxes only cash. So the combination of these three is almost similar to saying EBIT 1 minus T. That is the logic why we call it net operating profit less adjusted taxes, that the first three elements are sort of replicating. I'm not saying that these three are mathematically same as EBIT 1 minus T, no. But they are trying to replicate this entire process, that they pretty much represent operating income but adjusted for taxes which you have actually paid. So I hope this equation is clear. Let's do a question to understand the details of free cash flow.